In this video, we are going to look at monetary policy. This is the first in a two-part series on monetary and fiscal policy. First, we are going to compare monetary and fiscal policy. Fiscal policy is related to decisions that government can make in terms of taxes and spending. These decisions can be made to stimulate a fleeting economy or restrain a booming economy. Now, to stimulate the economy, we implement an expansionary fiscal policy. To achieve expansion, the key is to increase the budget deficit. This can be achieved either by reducing taxes or increasing spending, or by doing both. By implementing this kind of policy, aggregate demand in the market will be increased. The exact opposite can be done to implement a contractionary fiscal policy. Decreasing the budget deficit leads to a decrease in the aggregate demand, helping to stem a runaway economic growth. What we are talking about when we say monetary policy is the ability to control the money supply and to control the credit markets through interest rates. When we want to stimulate the economy and implement an expansionary monetary policy, we can increase the money supply and decrease interest rates, which will have the effect of increasing aggregate demand. Now, on the other hand, when we want to control inflation and rein in an expansion, we would implement a contractionary policy. To achieve a contraction in the economy, we decrease the money supply and allow rates to increase. The central bank has a number of tools available to help them implement their monetary policy. The first such tool they have is open market operations. This is where the central bank can step into the open market and buy or sell government securities. If they choose to buy government bonds, they put cash into the market, which increases the money supply, and as prices of government securities rise, interest rates fall. The next tool they have is the policy rate, which is the rate at which they lend money to other banks. In the US, it's called the discount rate. In Europe, it's called the refinancing rate. If they drop the policy rate, then they increase the money supply and promote lending. The last major tool they have to implement monetary policy is the required reserve ratio. If the central bank chose to decrease the required reserve ratio, then the banks would have more money available from deposits to lend out. But this is a seldom used tool. Now, in this next section, we are going to explain the relationship between monetary policy and economic growth, inflation, interest rates, and exchange rates. The key takeaway from this section is that the central bank does not actually have direct control over the growth rate of an economy. They can take action which impacts certain economic variables, which can in turn influence growth in the economy and inflation, but this happens through what is called a transmission mechanism, which is simply a series of chain reactions which lead from a central bank action, hopefully, to the desired effect. Let's look at the effect of an expansionary monetary policy. If the central bank wants to increase the money supply, they will go into the open market and start buying government securities. When they do this, the first effect will be that because of the increase in buyer appetite, security prices will rise. Increased prices will lead to a fall in short-term rates, and following that, we know that when borrowing is cheap and the opportunity cost of spending money goes down, it makes sense that people will spend more. And since businesses are able to borrow cheaply, they will be able to find more economically viable projects to undertake and invest in. So the third effect is that business investment and consumer spending go up. This will spark a rise in inflation as increasing demand leads to higher prices. Okay, so we know what effect the government securities buying program is going to have on consumption and investment, but we're not finished yet. Since the money supply in this country has gone up, and we assume the money supply in another country has stayed the same, then we can infer that our domestic currency will depreciate. Because if there are more euros circulating now, then each one of them must be worth a little less. Now, because our currency is cheaper, foreigners can enter the FX markets and buy our currency more cheaply, and with that, they will purchase more of our goods. So the final effect is that when our currency depreciates, we will see a rise in exports. After all of this, what is the net result in terms of GDP? Looking at the formula for real GDP, because interest rates are down, we now know that we will see an increase in the C and I terms. And also, from currency depreciation, our exports are up. So this X minus M term from the equation is also up. Overall, when the central bank goes out to buy securities and increase the money supply, we will see a positive change and economic growth. Next, we are asked to determine if a monetary policy is expansionary or contractionary. Now, this is basically asking us to understand what a neutral rate is and how to compare the neutral rate to the policy rate. The neutral rate is the money supply growth rate, which should put you right at the target inflation rate. At this rate, we should be neither increasing nor decreasing the economic growth rate. With the neutral rate, we account for the trend rate of real GDP and a target amount of inflation, where the trend rate is an estimate of the long-term sustainable growth rate of GDP. Now, if we have an expansionary monetary policy, how will our policy rate compare to the neutral rate? To be expansionary, our policy rate will be less than the neutral rate. Now, let's rationalize that out. We know that when rates go down, we have increased the money supply by stepping into the market to buy government securities. So when our policy rate is down below the neutral rate, we must be looking at an increase to the money supply and expansionary policy. On the other hand, if the policy rate is greater than the neutral rate, we know that we are looking at a tightening of the money supply, the sale of government securities, and a contractionary policy. Next, we need to describe some limitations of monetary policy. So here we are going to be thinking about some ways the monetary policy of even an effective central bank can fail to have the desired effect. Earlier in this reading, we spoke about the transmission mechanism by which a decision made by the central bank moves through the economy to influence a desired end result. This section talks about how the desired final effect gets lost along the way. Okay, so firstly, let's talk about inflation. If the central bank moves into the market to buy securities, they are looking to increase the money supply and bring rates down. But we know there are two effects of increasing the money supply. One is that the purchase of government securities will bring down rates, but the second is that with extra money in the market, we are going to get inflation from the increase in aggregate demand. According to the Fisher effect, both of these are going to have an impact on rates. So when the intention of the central bank is to drop rates by increasing the money supply, while they might get the desired effect in the short run, they might get the opposite effect in the long run because of inflation and because of uncertainty about inflation. The second limitation to monetary policy effectiveness is dependent on a side effect of monetary tightening. If we want to tighten up the credit markets and slow down the economy, we would move to raise short-term rates in the open market. The side effect is that this is viewed in the market as an impending recession. So even though short-term rates will rise, longer-term rates are going to fall because there is an attraction to longer-term bonds in recessionary times. Again, here you get this twist in the yield curve when the central bank is aiming for a shift of the entire curve. Thirdly, we have the elasticity of demand for money. When the central bank increases the supply of money, its intention is that people will take the available money and go out and spend it. When the money is spent in the market on interest-bearing securities, prices go up and yield rates go down. But if the demand for money is very elastic, then people will take the extra supply of money and just keep it. This effect, where the money supply increase does not lead to spending in the market and reduction of rates, is called a liquidity trap.